One of the popular questions that I've been receiving from a lot of people recently is simply, where do they set their take profit when they are trading? Well, when it comes to setting your take profit whilst trading, there are a lot of things that actually comes into play depending on the trade you are taking, how long you want to hold a trade, and how the market is moving. All this actually comes together to determine your take profit and stop loss in the market. However, for stop loss, I've created a video that I already talked about how to pick a perfect stop loss size to always make sure that when the market reverses against you, it doesn't get you out, and also you don't get to lose much. So now, putting that aside, when it comes to setting your take profit, there are a lot of things that goes into play, and in today's video, I'm going to break down to you every single thing you need to know to pick the right position for your take profit. So without taking much of your time, hello guys, welcome to my channel and welcome to Perez Trades. On this channel, I mainly focus on how you and I can make money through crypto, forex, and stock trading. So that aside, without taking much of your time, I believe you've already smashed that subscribe button, like this video, and let's get straight on my computer. Let me share with you every single thing you need to know about how you can pick a perfect stop loss position for your trade. Did I say perfect? Well, nothing is perfect. So let's get started.
So hello guys, now that we are on my laptop, I'm going to share with you a step-by-step guide on how you can pick a near perfect, I will not say perfect, but a near perfect position for your take profit position. Because when it comes over to trading, when you don't have a clear take profit, it's very difficult to determine where you are entering the market and where you want to get out of the market. So to make sure that you're getting the maximum profit from the market, I'm going to share with you the two different approaches of actually setting your stop loss. So now the first one I'm going to share with you is simply using key levels in the market. What do I mean by key levels? What I mean by key levels is simply the support and resistance areas in the market, using those ones as your take profit and stop loss position whilst trading. So for example, this is a pair between Euro US dollar, and this a pair I've already traded, so I just want to use the backtesting system to actually show you how it works. So now for example, if you look at this chart right now, the first thing you identify is that you need to mark out your key levels. So I'll take here as my key high, and then I'll look at this area as well. And then after noticing these two areas as your key, so now you have two take profit area. You have this top here to target as your take profit, and you have this midpoint here to target as your take profit. So now realistically, here is your take profit 1 and here is your take profit 2. If you are using multiple ordering system, whereby if the market is going to a direction, then you take another position again. And then now that you've known your take profit 1 and 2, now the first thing is that let me say I want to place an order. So let me use my trend line strategy. I'll just get my trend line across like this. I'll get across this top here, and I just adjust it down a little bit. Okay, good. So now refresh. So now I have this trend line here which is already been broken. So for example, let me say I want to place a buy order in this market now. So based on the way I trade my trend lines, I'm not going to rush into this market until the market falls back to this area to retest it. So now let's wait for the market to retest it, then I'm going to place my order, then we'll see how it goes. So this is a 1 hour chart. So let me just go back to a lower time frame. I want to show you the importance of using key levels as your take profit areas, because when you use key levels as your take profit area, it gives you the opportunity to get out in a safe zone even when the market did not hit your main take profit. Because when you use a key level, at a key level, you're always expecting that the market can possibly change direction, and to make sure that that change of direction doesn't get you out, that's where you need to understand the concept I'm about sharing with you in today's video. So for example, here now I have to take profit here. Here's the first one here, and then this top here is the second one. So now if the market should get here and I see any sort of heavy drawdown, I'm going to get out of the market. And then on the other hand, if the market should break above here and I don't see any sort of heavy drawdown, then I can actually let it slide through. So now let's see how it actually plays out. So you see, now let me tell you something. Now take a look at this chart right now. You can see that when the market actually approached this first key level, this is a key level. The reason why this is a key level is that when you draw the trend line, we realize that this is a point whereby the market came back to retest the trend line, and this area now was a high selling momentum around this area. So whilst trading, when you place your order, you have to put in mind that, okay, there was a high selling momentum at this point of the market, meaning there is still a high probability of another selling momentum coming in. So now when you are trading and you keep your take profit in this sort of position, you need to set an alert in this area so that once the market gets here, you receive a notification that, okay, the market's at a key level now, so that you can go watch your chart and look for any form of heavy reversal. So in case you don't see any heavy reversal, then you can leave it, because in most cases these areas often create heavy reversals that might get you out of the market, like what happened to me on Great Britain pounds and Japanese yen today. I placed an order, the market was at a key level, but then I wasn't monitoring the market. After the alert came in, it went above the key level and I wasn't monitoring it. And then a few hours later, I came back to realize that from getting into, let me just say, from 10 pips away from my take profit of aiming for almost 60 to 100 pips, I realized that the market just went from 10 pips away from hitting my take profit to actually hitting my stop loss. This is because I set an alert at a key level, but I did not come to check the market at the key level. That's why I'm advising that if you are trading and you set an alert at a key take profit level and the market get there, as long as the area was an area of value before, always go back to your chart and then monitor the market movement around there. So now, for example, now once the market gets here, now I will be very cautious. So at this point now, I will add another alert here. So based on the way I use my TradingView, I'm going to set an alert below here. The reason why I'll keep an alert here is that in case the market should come back and break below here on the 30 minutes that I'm trading, it shows that the market has broken the previous structure, because you can see the market movement that it went upwards. Let me show you something. Up, got here, and if the market should come back down here again, it's clear that it has broken this previous structure, so it might come and retest here and then sell back down again. Now to avoid this, once you set alert at a key level as your take profit, like the one I did here being my take profit one, in case I sight any sort of movement that is related to this one, I'm getting out of the market immediately to avoid being stopped at. Now a lot of people will tell you that is trading with fear. Well, the truth is that it's not actually trading with fear, but it's been trading with caution, because once the market breaks a key level, there's a high probability that it's not going to go back to that area again. Like for example, if this market should break out of this area, now it's clear that the market is heading to this top here as our take profit. But then if the market should reverse that and broke below this previous swing low that it created, it shows that the market is ready for a sell, meaning it's trying to respect this old key level that it created here and then sell back down again. So now here's the first approach to actually setting your take profit position whilst trading. Is simply using the previous key levels as your stop loss, like for the previous areas whereby you had a high selling momentum or a high buying momentum. Like for example, I was placing a buy order, so I'll look into my left side and then look for where there was a high selling momentum. Like for example, the places whereby there were high selling momentums is here. Here was where the high selling momentum began, here, and then around here it pulled back to retest the trend line again. Let me mark it out. Around here it pulled back to retest the trend line again, meaning there was under high selling momentum again. So now at this point now I will just be watching, and now let's see where the market actually head to from here. What did you see the market do? You see that the market has broken below our key level here now. So now at this point now, this is where I need to be very vigilant. Like I need to be very vigilant to make sure that the market doesn't get straight to my stop loss position anymore, because you can see that the market has broken below this previous swing low. This is the importance of setting an alert. So if it's the way I personally trade now, the way I personally trade is that I'll be waiting for this market, this particular market here. Let me mark it out for you. Now this area here, I'll be very cautious of whatever thing that happens in this area on the lower time frame, because the lower time frame accumulates to create the higher time frame. So I'll be very worried, careful about what happened here. So from here now, if I see any sort of bearish more movement in the market and it was not created because of a negative news impact, then I'll get out of the trade. This is how I manage my, because one thing I do as a trader is that I don't play with my capital. maintenance is very important thing to me, so I always make sure that I maintain that my capital. Anything that will get me below my capital, I actually don't want it, so I always watch out for it. This doesn't mean that I don't lose trade. I lose trade, like the one I told you today. The trade here got to my first key level where I should have gotten, which is my take profit one, but I decided that okay, let me keep it for a little bit, but then something took my attention, so before I got back, market was in my stop loss position, which wasn't friendly. So now from here, now let's see what the market does from here. Boom. You see this heavy drawdown? You see from this heavy drawdown here, this initial one here, I'll be looking forward to get out of the market, and then I'll get in again when I see all this rejection. This is simply how I trade as a day trader. And if you should look at it right now, this trade isn't on the same day. Guys, we open our initial trade on the 24th of April. This was our 3rd of April, sorry, 3rd of April, and then this trade is still running till Friday, which is 5th of April. And I'm not fond of holding trade for 2 days. Once I hold my trade the first day, the second day, then I consider getting out of the market. So for this, I would have gotten out when I see all these double week rejections showing that the market is finding it difficult to break above there. So you can see how all the difficulties is finding. This is why once the market gets to your first key level area, you should be looking forward to get out from that particular position. The most important thing is that you close in on a profit. But then once the market gets there and it doesn't show you any sort of key rejection, then what you can let it continue to your main take profit position, which is the one at the very top. So now this is simply the first one, is simply using key levels as your stop loss position, as your take profit position. I mean, like for example, if you are entering a bullish market, like you want to place a buy order where you had high selling momentums, should be your take profit target, so that once you see any sort of rejection around those areas again, you get out of the market. That's simply the first step into setting your your take profit position. Now, that being your first step, the second step here is simply having a fixed risk to reward whilst trading. So what do I mean by fixed risk to reward? A fixed risk to reward, it simply means that, okay, you want to place a trade, but you need to make sure that per every single trade you take, if you are risking $100, you should be making up to if you are risking $100, you should be making up to $200 to $300 profit. So for example, let's say you aim for a 1:1, a 1:2, meaning if you are risking $100, you want to make $200 from the market. So now in this one, now the first thing you consider is your stop loss position. And for this particular video, I'm not going to talk much about stop loss position because I've already covered it into detail in my other video, which you can check in this video description as well. So now coming back to what we have on the screen here. So now when it comes to using the fixed risk to reward ratio, that's where this TradingView system actually comes in. Now let me cut it back to our initial entry again. So now when it comes to doing that, one thing I actually do is that I use my risk to position taker on TradingView. So I simply take my position taker, I'll put out my entry. Then after that, I'll look for a good stop loss position. So for this, let me say the market has broken this downtrend, came back to retest this previous area, meaning that it's likely to buy from here, meaning I've gotten a good entry position. Now my stop loss, I'll keep it some pips below this key level here, and then now I'll look for a 1:2 take profit position. So here is a 1:2. You can see a solid 1:2 has been spotted around this area. So from here now, I can just enter in like this and then wait for the market to get there. So whenever the market get there, then I'll get that. This is how the 1:2 strategy work. And if you look at it right now, we hit the 1:2 strategy. Very much simple and straightforward. So now when it comes to trading, you can either choose to go for the 1:2 strategy or 1:3, but having a proper fixed risk to reward ratio will actually help you. But then if you think that isn't really good for you, if you see a lot of liquidity in the market that you think the market might actually go and grab off, then you can utilize the key level system, which is the one I actually use here. So for those of you who trade ICT smart money concept, you can use areas like other blocks, your fair value gaps, and the rest as your take profit positions. While for those of you who trade normal price action, who rely on support and resistance and trend line, then your areas of trend line kisses should be your areas of target or your key support and resistance levels in the market. So I hope you find this video helpful and you've understood the idea of setting a perfect take profit position to make sure that you actually don't get stop at in the market. One of them is using the key levels in the market as your zones, or the second one is actually using a fixed risk to reward, meaning saying that okay, for every trade you take, you want to be risking a 1:2, and that is all you will do. So that already said, hope you find this video helpful. Don't forget to smash that subscribe button, like this video, and tell me what you feel down in the comment section. Have a nice day. Bye.